Hi, I'm Frankie Aiken, the Chief Financial Officer at the Berks County Community Foundation. Often I get donors who call or professional advisors who call, often asking questions about our investment strategy and how the other assets of the Community Foundation are invested. I thought it would be a good idea to ask Bill Hummel, who is the expert at that. Bill Hummel is with Fund Evaluation Group, our investment consulting firm who advises our investment committee on the investment strategy that the Community Foundation should employ.
Hurdle rate is really focused on trying to match the finances of the organization. So the hurdle rate is looking at an organization's spending rate, factoring in inflation, and then any non-investment related fees. So we show everything net of fees. That's why we don't focus on the investment manager fees. But our hurdle rate for a typical organization would be about 8 to 8.5%. So 5% spending, 2.5% for inflation, and then maybe a half to a full percent for non-investment related fees. And then the idea from there is to say, well, how can we build a portfolio that gives you more often than not the ability to actually achieve that hurdle rate over long periods of time. Just going back to the hurdle rate, if the hurdle rate is saying for the Community Foundation that we need about 8.5% because our spending's 5%, we have 2.5% for inflation, and then other related fees add up to about 8.5%. And back in the 80s and 90s, you could have achieved that pretty easily with a 50-50 split between stocks and bonds in a high interest rate environment, declining interest rate environment that really had large stocks averaging 18% returns, bonds averaging 9%, and there you had your hurdle rate. So two asset classes served that goal. However, now in a low interest rate environment, you really have a challenge of, well, those two can't be the sole driver. You need other asset classes to help get that 8.5% more often than not. Therefore, that's why the asset allocations tilt towards equities to achieve that because of the low interest rate environment we're in. And then also, if someone was to look at the portfolio of investments, they'd see that it's spread out amongst different asset classes. Our research and experience has shown that not one manager is really good at picking all the different asset classes that are out there. And then again, as we try to serve that hurdle rate more often than not and know that it's challenged by the low interest rate environment we're in, we're going to need other managers with vehicles in other asset classes to help build a portfolio to help us achieve that 8.5% return goal that we need out of the portfolio. So that's really the catalyst for why we have roughly the managers we have in the portfolio today, why we're tilted towards equities the way we are. And again, the asset classes run the gamut from large stocks to international stocks, emerging markets, bank loans, sometimes real estate, and other areas. Most recently, we added an investment-grade bond manager. And again, I go back to the fact that not one manager is an expert in all those different areas, so we try to really create a best-in-class or best practices for the investment strategy. In terms of size, not-for-profits both in the community foundation side and college university side, you'd find that Berks is very similar in its asset allocation approach. The reason being, again, many of these organizations have a very similar spend rate, and they have similar goals in terms of what they're trying to achieve for their particular organization. The difference is going to lie in more organizations that tend to have larger endowments and therefore the ability to go into alternatives and illiquid strategies much more than maybe this organization could. In terms of other endowments, we trailed in 2008 predominantly because again, our search was to try to serve a long-term goal of covering that hurdle rate and looking at the low interest rate environment of what treasuries could offer. We found it very unattractive. Therefore, we were looking at global fixed income managers, bank loan managers, other strategies that in 2008 were really not embraced by the market because what had happened in 2008 was just a flight or fear in the market that led to people wanting and buying treasuries in the marketplace and driving down the yield. So if you were to look at all the different asset classes and how they performed, you'd find that treasuries had the best returns since the mid-90s. Corporate bonds, municipal bonds had some of the worst returns that they've had in the mid-90s. High-yield bonds, worst returns on record, and even large cap and small cap equities, worst returns since the 30s. And then we also do make international investments. And so with that flight of fear and buying of treasuries, it also inevitably rewarded not only Treasury bond holders, but also those strengthen the dollar. So if we had international investments, the strengthening of the dollar actually hurt our international investments. And again, you'd find that for international and emerging markets, they had the worst returns on record in 2008. So that diversified strategy that we talked about earlier has historically worked well for us, and most recently, as even 2001, that would have worked just fine. However, because of the flight of fear and buying of treasuries and rewarding the dollar and strengthening of the dollar, that really hurt a very diversified portfolio. Again, this is a long-term focus on investing, and as I mentioned in 2008, fundamentally things were intact. It was more of a systematic global meltdown on a scale that was not easily determined on a fundamental basis. So leverage was hurting a lot of the financial system, and the financial system systematically was tested that way. Our long-term fundamentals on the asset classes and how we're trying to serve the hurdle rate were still intact, and we realized that there was going to be some short-term pain, but long-term we think a lot of gain served by the way we have our asset allocation in the portfolio today. And again, some of that's starting to come to fruition in the sense of 2009. We're starting to see an appetite for credit, people getting out of treasuries, going into fixed income in other regards. High-yield bonds are doing quite well this year, and many of the equities are doing quite well, including international, which is up double digits, and emerging markets nearly 40%. So while in a given quarter or a given year we might see that we don't achieve our hurdle rate of covering spending, inflation, and fees, we think ultimately long-term, and again this is long-term money and money managed in perpetuity, that will serve the needs of the community better by keeping our asset allocation intact and not knee-jerk reacting to market swings like what we've seen in 2008. Jokingly say, certainly better than 2008. That's I can't put a guarantee on it, but certainly it looks like 2009 is shaping up that way. But over the next couple of years, as we see the system start to get back into place and certainly credit markets free-flowing, our expectations are certainly more focused on longer term, but near term we think there's going to be a nice rebound, some of which we've experienced to date. We think more will be coming, but there's certainly some question marks along the way too. So probably still some fits and starts, but certainly better and certainly working off a bottom that we've already experienced at this point in time. Looking out over the next decade is where we kind of spend most of our time on our capital market assumptions, and a lot of the assumptions are equity returns on the large cap side in excess of 10%. Same thing with international. Emerging markets are very strong. And then more recently, again, Community Foundation, we've been looking at some of the opportunities in the marketplace that are present today. So investment grade, high grade corporate bonds with yields up until recently that were in excess of 7%, and certainly yield advantages over treasuries that are very compelling, almost equity-like. We took advantage of that, and although we've been in this strategy for just a short period of time, the strategy's worked well. Less than a quarter, and we've been up 10% so far. And so that's the idea, is that while the market may dislocate itself on a short-term basis, we are cognizant of opportunities that present themselves. But again, all serving a long-term goal of covering that hurdle rate more often than not.